Hello and welcome everyone. Thanks for coming out to this presentation, SPACs by the Numbers. I'm Ben Kwasnick, founder and CEO of SPAC Research, which is the leading provider of data and insights on the SPAC market. I'll cover three broad topics today: front-end SPAC IPO activity, market dynamics and trading characteristics, and deal and financing trends. So we'll try and get a holistic view of where the market's at now that it's been inflecting positively for almost a year or so, as we've been working off the overhang of excess from the COVID-era SPAC boom. We'll start with SPAC IPOs, which, as you've already seen here today, have ramped up considerably since a low watermark during 2022. The market was saturated with SPAC paper from 2021's excessive issuance, but redemptions came in mass during 2023, and issuers started filling the void in the middle of last year. And the market really kicked into gear in Q2 with more than $8 billion worth of issuance across 40 deals, and a couple of weeks still remaining in June. Highest level of issuance in 3 years, it's showing no signs of slowing down, with a large and growing pipeline of new S1s continuing to come in. The other thing to note here is that a significant majority of filings this year have come from repeat sponsors who've been through the cycle before. It's promising to see industry veterans coming back for another vehicle because their assessment of their own prospects are likely more realistic than for first-timers. So with the uptick in IPOs, we're finally seeing the total size of the SPAC market expand again. It peaked at almost $200 billion back in 22 and fell really hard as liquidations hit sponsors and redemptions at extensions took many vehicles' trust accounts back. The SPAC market bottomed at $12.5 billion last year, and we're now approaching $25 billion. So if we can just do $3 billion a quarter in IPO volume, that leads to this market size around 25, which is a much more sustainable equilibrium for the product. I'm getting asked pretty often by journalists why the market's heating up again. The regular IPO market has been challenged, and SPACs are still available as a listing route, but that's been true for quite a while. We're finally seeing some good deals come out with meaningful primary issuance of common stock, but those can be hard to predict forward, and some deals are trading well, but they're often based around hot investment themes. But the important thing to consider is that demand for SPAC paper never fell off during the market downturn. Yield investors are still thrilled to allocate to a strategy that can reliably beat treasuries by 30 or 50 basis points. And the governing factor on IPOs was a lack of sponsors willing to commit risk capital and 2 years of their life to making a vehicle work. So what you're seeing on this slide is the trend over the past few years in IPO features. The blue line is showing that IPOs over the past 3 years have gone from overfunding their trust accounts on average at 102% to just a hair over 100% today. And the green line is showing us that 2022's IPOs had almost a full warrant coverage included, and we're now down to around half a warrant today. And on top of that, 3 years ago, sponsors were getting just over 15 months from IPO to close their deal without any optional extensions. And now teams are getting around almost 2 full years again. It boils down to much more generous conditions for sponsors than at any time in recent memory. So if you look at the market in the context of the pain point of finding supply of sponsors to take a vehicle public, it's not hard to see why this year has seen more teams getting out the door. One thing missing here is the bulge bracket. We've only seen 2 bulge-led IPOs this year, which is disappointing if you believe their participation is important for the SPAC market's momentum to continue. But of course, yesterday, we saw that Goldman Sachs is coming back into the market. We're also seeing some really interesting competition on banking fees this year, with a handful of big names like Alec Gores and Michael Klein leaving their longtime SPAC bankers and coming back to the market with new firms on the cover and alternate fee arrangements. Here's a closer look at just how much easier it is for teams to go public right now. The blue line is how much it cost to sponsor a SPAC in 22 and 23 across various sizes of SPAC. You can see it cost $8 to $9 million for a $200 million IPO during that period. And the green line is showing how much cheaper it's been last year and this year. Now it costs something like $5 million for the same vehicle. We've got less trust overfunding, banking fees are edging lower, SPAC components are trading better, so everything is really just pointing in the direction of less resistance for sponsors to come back to the market. The other thing to note here is that a lot of IPOs are coming to market with non-managing sponsor investors, basically hedge funds that are taking down a big chunk of the IPO allocation as well as the risk cap. It brings the cost down even further for sponsors, but it's really not what you want to see either as an investor hoping for something beyond the yield to worst, or for the SPAC market writ large. So we're hoping for this trend to continue to go by the wayside as the SPAC market gets healthier and sponsors want to tie more of their own money to the success of the vehicle. We're moving into market dynamics here, and the first thing I want to highlight is the median yield on pre-deal SPACs. You can see from the green line that we're in an almost year-long bull market for SPAC shares. It's taken the median yield from above 6% to around 5%. And what this means is that a generic SPAC with 2 years to go might trade at around 9.85 versus almost 20 cents lower than that a year ago. It's another contributing factor to easier IPO conditions, and it's happening in part because short-term rates are down, but also because the equity premium has crept back in for a number of SPACs. We've seen deals trading much better recently, especially within a handful of investment themes like crypto and nuclear energy. And so pre-deal SPACs focused on those areas are now trading at a significant premium to the rest of the group. More than 10% of the 140 or so pre-deal SPACs are actually trading above trust, and roughly a quarter of the live deals out there are trading above trust as well. Another interesting thing to see here is our warrant index. What we're measuring here is the market cap of warrants attached to pre-deal SPACs. And then we express it as a percentage of the initial trust value of those same SPACs. So a value of 0.01 means that the average $100 million SPAC might have $1 million worth of warrant market cap. You can also think of it as the value that IPO buyers are holding from the warrant portion of their purchase. We limited the scale here to a couple years, so you can actually see that warrants are well below where they were in 22 and 21, but they're also up nearly 200% off of the lows from last year. And many warrants are enjoying meaningful speculative interest. Newly split warrants are showing price improvement too, and it's an exciting measurement of the renewed enthusiasm for the product. So we've seen the adjustment in the way the market's valuing various pre-deal SPAC securities, which is encouraging. But one of the most exciting changes is here on this slide, and it's the change in the character of deals that are getting announced this year. The blue bars represent the median deal size, which has been steadily increasing over the past couple of years, and at nearly $500 million is a much healthier number than it was 2 years ago. Billion-dollar deals were largely absent from the market in 23 and 24, but more than 1/3 of this year's deals have been $1 billion or larger in terms of enterprise value, and it's exciting to see larger companies choosing the SPAC route again for a listing, especially in connection with reputable sponsors who have a chance at helping their company hold its deal valuation through closing. You can also see with the green line on this chart that many fewer deals are coming to market, which might initially read as a negative, but it mostly reflects the decrease in SPACs that were left for dead, with little or no trust cash remaining, and in many cases having fallen off to OTC listings. The deal count is much lower this year, but it's unmistakable that the ones we're seeing are of higher quality. Another encouraging development on deals here is the way that deals are getting financed. This is a fully stacked bar chart, so what you're seeing is the fraction of deals that came out in any given quarter broken into cohorts by the type of financing they've lined up at announcement. You can see from those bars that are entirely dark blue during 2024 that last year we had multiple quarters in a row without any committed financing at all at deal announcement. But this year the pipe market has shown back up again, and we've seen a handful of pipes into the hundreds of millions of dollars, and all struck at a price of $10 per share or higher. We know that deals are a lot easier to sell to the public if institutional investors are committing capital in advance. And so this goes a long way toward revitalizing the SPAC market and giving deals an easier runway post-closing. One big thing still missing here is, again, the bulge bracket. Big firms have been very slow to come back to the market, likely a hangover from that uncertain liability shadow cast by the Gensler SEC. So bulge firms have remained very selective to avoid risk, with only a couple of deal engagements they're working on across the entire space right now. But again, we expect that to change with Goldman coming back into the market and other bulge firms likely to follow. So it's nice to see deals securing meaningful capital commitments without relying on redemptions, because the average redemption rate is still super high at closing. This year's deals have been closing with less than 3 to 5% of their original share count, which is obviously not what targets are looking for. The good news is that more than a quarter of the live deals out there are currently trading at a premium to cash and trust, which suggests redemption rates are primed to fall imminently, and that SPACs will be able to deliver more capital to their targets in the second half of this year and hopefully beyond. That's it for the presentation. We hope you'll visit us at SPACresearch.com and sign up for a free trial account. We operate the most comprehensive SPAC database out there, and we regularly publish research and analysis like what you've seen here today in our newsletter. And you can email me or find our sales team at our table inside. And I'll take any questions. Okay. Thank you.